Hello, and welcome to another episode of the Profit Minds podcast. I'm your host, Dr. Stephen Kirch, creator of the Profit Minds Growth System, a unique blend of profit growth, productivity acceleration, and building robust business process for scale. In every episode, I interview entrepreneurs and small business owners from around the world with a unique story to tell. You can find the show on YouTube, LinkedIn, Apple and Google Podcasts, Stitcher, Spotify, and more. Well, hi, everyone. Today, my guest is Erik Brenner, founding partner and CEO of Hilltop Wealth and Tax Solutions. And today, we're going to talk about why you might need a personal CFO. Welcome, Erik.
Well, thanks for having me, Steve. I appreciate it.
Yeah. So, this is the way I start every podcast. Tell me your story. How did you wind up as the founding partner of this Hilltop Wealth Solutions?
Yeah, I mean, it goes a ways back, like every story. And I grew up my father was an entrepreneur and owned a business. And so when I was off of school, I would go to work with him. And it just, being a business owner just always intrigued me. And I really don't know any different. And then when we got to a point where, we were starting to talk about transition and, his succession and retirement, it was just something I thought, I think there's something better out there. And so we really kind of were looking for other, what else can we do? And really what I can do, because he was wanting to slow down and retire. And, I stumbled about, over this industry on financial advice. And it was very interesting to me. I always liked, finance and investments, and, it was new. And so that was 32 years ago. And so what's happened is, I've continued to kind of develop as a financial advisor, and then it grew into really a firm and having other people really within the organization helping clients, just make really good financial decisions every day.
Yeah. So what business was your father in?
Yeah, he was in an automotive aftermarket business, and he had done that for 25 years. And, there was a lot of learning there. I really believe as entrepreneur and me being one, but, it takes a special person and you learn a lot, along the way. And I had a couple other key family members, that were also entrepreneurs of different businesses. So I really learned a lot at a fairly young age. I would say that I certainly got a college education in entrepreneurship, by on the job training.
Yeah, no, and that's incredibly valuable. Just out of curiosity, what would you say the biggest thing you learned from your father as an entrepreneur? What was the biggest takeaway?
Yeah, I mean, for me to like identify one, it becomes a little difficult, but
Okay, two
I
or three
think
then.
that, yeah,
But
but I think probably the biggest is that nothing replaces really hard work. And then I'd say close to that is just doing the right thing. So, I can kind of remember in situations, and, now it's been many years ago, but, he would often have discussions on, is this the right thing? In whatever you're doing, right? Whether you're working with the customer or working with someone that works for you, or, is it, doing the right thing? And then the hard work, right? So doing the right thing with the hard work, equals somebody that can have success in what they're doing.
yeah, I think that's really important. The values that we get from our parents, what matters to them, not only what they say, but how they act and who they are. Right? That's
Absolutely. The other thing, Steve, I think is kind of there's a lot of unspoken. So, I'm a big believer in, kind of what you do rubs off, or, it sets the tone. And so it wasn't necessarily, Erik, here's how we do this, because it was, often it was how he went about it and did it. and it was that tone that he set. And so, I picked up a lot of that, over that time period that I've used and I still use today.
Sure. Yeah. So talk to me a little bit about your wealth advising practice and what you do for your clients.
Yeah, so we are a fully independent wealth management, financial planning, and we have a tax business. So we do tax accounting and so forth as well. And so what we do is we work with individuals, business owners, medical professionals, doctors, is mainly the groups of people we work with, and we really help them what we call along their financial journey. Really, it's not just about investments, although that's important. We've grown over the last few years of being much more comprehensive. And the way we get people to think about it is, if you think about it related to a medical practice, and I saw this in my own kind of situation, that for years the general practitioner, our family doctor suited me fine. Go in for a physical, everything's good, and then as I've gotten older, and things get older as well, then my knees hurt. Well, then I got to go to the specialist and the orthopedic, and so now I'm into kind of specialist, right? And so we think about that in the financial aspect. Is a general practitioner is good to get started, get your feet in the ground, get kind of a good plan in place. But then really the specialist comes into play because of the complexities that oftentimes we see people are in when they get to and into retirement.
Yeah. So talk to me a little bit about that. So many people, they get started down this path, or they're saving, they think they're saving enough money, they're saving, what's the time that you need to start really thinking about what you're going to need in retirement? When should that conversation start with a specialist like yourself?
Yeah. Yeah. So assuming that they've got good principles and good start, then they get to kind of the early 50s typically, where they're now maybe getting at an age, maybe kids are in college or maybe even they're gone. They still have some time left. You don't want to get behind the eight ball, so to speak, Steve, where, you don't have time to catch up. But now you're getting into a situation where you may have some more complexities. Maybe your income continues to grow. You're definitely thinking more about, well, I'd like to retire, at this age. And it's not about really walking into, I'm going to retire next year, so I need to get that specialist today. We find that if we have a few years of trajectory, that's more important. And then, okay, I'm retiring. Now I go seek them.
Right. Yeah. So you're talking about like 5 or 10 years kind of
Yeah, five,
before?
10 years. I mean, 10 years really is a great mix. We certainly work with folks that are more than 10 years away. But 10 years is a great side of it. The other thing is that the complexities and what's happened and I've seen in 30 years is just things have gotten way more complex. I mean, we've had some tremendous large tax law changes, three of them to be exact, since 2020. So in 5 years, we've had these major kind of tax law changes, and the latest one being the one big beautiful bill. And so it just continues to become more and more complex. And so navigating that when someone's trying to have their own career, right, and is really, really difficult. And so being able to have somebody that does this all the time, I think becomes very valuable.
Yeah, so talk a little bit more about that. I mean, I'm guessing that there are some of the listeners here who have been, in business for themselves for a while and thinking about, the exit that they might have, and how do you help them understand, what it is that they need to do to prepare, and how to stay ahead of these? Because my bet is this isn't the last tax law change we're going to see between now and the
Yeah.
time the listeners maybe actually retire or, so talk a little bit about, how do you make sure that everybody stays on top?
Yeah. So, and it's a good point. You're right. I mean, we're not going to try to guess the future, but chances are, yeah, tax law changes. I mean, as one good CPA said one time, all good tax laws are written in pencil, right? They're easy to kind of erase and change. But so, what we do when we call ourselves a personal CFO. So you think about a business, a successful business. As businesses grow, they often have someone, right? That's their CFO, their chief financial officer. And really, yes, they run the finances side of the business. They're there to give you their expertise. And then they also have integrated responsibilities and operations and other things within the company. So, we really act as a quarterback to bring together if you need the tax professionals, the legal professionals, the plan, right? What is your succession plan if you have one? And not be geared to product. What we say to people is there's all kinds of product you can purchase. You really need an independent, right? Advisor that really can help you all along the path. Of course, I am an entrepreneur myself. I have bought and sold businesses, so I've lived that life. And I do think that puts it a little bit different perspective, and making sure that someone, has that working on their side from a personal basis. So you could have a company that's large enough where you have a CFO, but they're really probably not looking out for you personally.
No.
Looking
Yeah.
out for your business, but they're not looking out for you personally. So that's how we bring that all together.
Yeah. And when I think CFO, I think of somebody that looks at cash flow, projects cash flow, and does a cash flow projections. Obviously, looking at the expenses, taxes, all of those kinds of things. Is that what we're talking about here as well?
That's what we're talking about. Exactly. So, and then oftentimes, in our field, if someone's an advisor, they really end up focusing on the investment side. And
Right.
so there's not a lot of discussion on the tax side. And so I think about taxes as a way of, you have completing your tax returns, which is putting numbers in the box. And then there's tax planning, true tax planning, saying, okay, what's the trajectory? What's your projected tax situation for this year, right? For the current year, so that you could make adjustments and changes in the current year to help from a tax perspective. So, I think a lot of times people just overlook that, especially if they have some success and, they have the income to pay for the tax. So they just kind of get used to it. "Oh, I hate paying taxes. I'm paying too much," but nothing's done. And unless you're proactive, your taxes pretty much won't change. You have to
Yeah.
be proactive. I tell folks a lot that the IRS is not going to call you to tell you you paid too much in income taxes,
Really?
right? Really.
Yeah.
I know a lot of people are probably waiting for that phone call,
Uh,
but they're not going to do that. And so, and the tax codes, right? Again, extremely complex. So there's ways to utilize the tax codes often to people's benefits, but they just don't know how to utilize them. So that's where we come in helping them in all aspects of their financial life, right? Taxes being one of them, and how we incorporate all of that is really what we think is key.
can you give us an example of how you could leverage the tax code to really make a difference for
Sure.
for
I'll give you an example. So when we talk about tax planning, I think tax planning gets thrown around way too much. We do tax planning. So tax planning looks at, deferral. So I could defer taxes down the road. That's kicking the can down the road.
Mhm.
You certainly in a business, if you own a business, there's deductions, and then there's mitigation. So mitigation is you save money in tax and you never pay it back. you kick the can down the road. So I think all of those worked in, right, as a good combination, are really important. So one of the things that I like people to think about is every now and then, they post, or there's an article on these multi-billionaires that, are in the 12% tax bracket. And if you ever read into the article, you think, well, how is that possible? They're worth all this, they're high net worth clients, high net worth people, excuse me. How are they in the 12% bracket? Well, there's a lot behind the scenes, but I will tell you that I know of a couple key things. Number one is they have really, really smart people working for them. And I know some of those people that work for some of those high net worth folks, but they're really smart and they know the tax code and how to use them. So they utilize those things that are available to them. And so by integrating all of that and how you manage it, and then the other flip side is what's happened over the last couple decades plus is retirement has gotten way more complex with a lot of different options and so forth than, our grandfather did, or even father.
Yeah. Okay. So let's say I'm a high income earner, right? I'm presuming that that's your target demographic is people that make a reasonable amount of money, right? What are some of those blind spots, things that they may not think about? You've talked about taxes, but what are some of the other things that they don't usually think about?
Yeah. So when you're a high income earner or higher income earner, we are educated, and you have retirement plans. We're educated to put the money into the retirement plan and save. That's great, right? Save. A lot of people max out what they can save within their retirement plan, whether they're an employee or they have their own business. But oftentimes they put it in and then they deduct it. So the thought is deduct it today because you're a high income earner. And then when you retire, you'll take it out at a lower tax rate. And so what we are seeing is that may not be the case. And one of the major reasons is that money that you deferred, you deducted it today and you're deferring it, now gets to a size that when you run your minimum calculations you must take, okay, there's some issues with those qualified assets, IRAs, 401ks, and so forth. And they're getting so large that the calculations are so large that we see people that maybe they drop tax brackets for 2 or 3 or 4 years in retirement, and then they start climbing the mountain, climbing the tax mountain. And it's growing. Again, I said, there's a lot of differences between 2 decades ago and today. This is one of them. They didn't have 401ks. The 401ks created in the 80s. It wasn't that, they've been around since the 50s. So they didn't have those plans. And so someone retired, they had a pension. They chose, do I leave something to my spouse if I'm married? Done. They never had to manage a pot of money. If they both passed away, the pension's done. That's not the case anymore. So there's trillions of dollars that sit in these plans in the US, okay? And depending on the number you look at, it's upwards of $40 trillion that have yet to be taxed. So we're seeing these pots continue to grow, and there are tax problems on the other end.
Yeah. So you've made several comments about, what your parents did or what your grandparents did not going to work. What are some of those things that you think that people often come to you with, well, this is what I'm going to do, this is what my parents did, that kind of stuff that people need to be aware that they need to maybe rethink.
Yeah, rethink. So one is what I just mentioned, right?
Yeah.
You need to look at projections as to what is your required distributions, right, projected to be.
Okay.
Okay, so thinking ahead, what is it projected to be? Secondly is Social Security. So we have people today, the couple that have paid into Social Security, they're close to $100,000 a year in Social Security. So 20 years ago, it was $900 a month. Right. So people in their Social Security, and oftentimes people we see they can just live off their Social Security. And then they have these other assets. So that's the second piece. Third piece is healthcare. 20 years ago, many of the companies, when you retired, you were able to transport or keep your healthcare, and most cannot if it's prior to 65. So they have to figure out healthcare. That's the next thing. They also didn't deal 20 years ago with what's called 𝐒𝐫𝐻. So 𝐒𝐫𝐻 is if you make more than a threshold amount, once you're on Medicare, you will pay more for your Medicare. So people get pushed into 𝐒𝐫𝐻 limits, okay, and they start paying more on their Medicare. That also didn't exist. So when you add up all these things, right, the other piece of it, I think, Steve, is the choice of investments. So, they choose investments, right? Now we have obviously thousands and thousands. I mean, there's so many choice. Do I do this? Do I do this exchange traded fund? Do I do private equity? What do I do? So that also didn't exist because, again, if a lot of people had pensions, not everybody, but they could, work there, fully vested, retire, full health benefits. And again, with their pension, they make one-time choice. If I have a spouse, do I want to leave 100%, 50%? What percentage to my spouse? If I die, done. They didn't have to manage a pot of money. Same way with Social Security. And then the last one, Steve, I think about that's big is life expectancy. So, again, 20 years ago, people's life expectancy was much sooner. So with advances in medicine and we continue, people's life expectancy, right, are just going to continue to push out. And so you could be retired longer than you worked. We've seen it. It's a real possibility. And that's one thing, quite frankly, why pensions got pretty much eliminated. They were very costly, and someone was on a pension plan payout for longer than they worked at the company.
Yeah. No,
so those are the real keys that I see.
I fully expect to be retired longer than than I worked.
Yeah. Right? So that, 20, 25 years ago, I think about that, and I think through my kind of family dynamics, and, they've pretty much, most of the next generation is, if they've outlived their parents' generation, right? So those things will really add up over time.
Yeah. So the message, folks, is look at your finances. You probably need a personal CFO. And if you do, give Erik a call. Erik, do you have a gift for our listeners?
I do, Steve. I wrote a book actually on this called The Personal CFO Revolution, Navigating Your Financial Mountain. And so I'm glad to give that away for your listeners. And so they can go to hilltopwealthtax.com/podcast. So that's hilltopwealthtax.com/podcast.
We'll put that in the show notes. Yeah.
Yeah, that's great. Thank you. They can get their free copy there. And then also they get a chance if they want to have a conversation. We do 15-minute intro calls with one of my team members. They'll find out more about you. You find out a little bit more about us. And then we'll see if there's a fit. There's really no pressure. We'll see if there's a fit to then have a conversation with one of our wealth advisors and, see if we can help, if there's a fit or not. If we can't, at least we'll give you one or two things that will help your situation moving forward.
Yeah. So is that the best way for people to get out and get in touch with you? Just go to the website?
That's the best way. The website also has a lot of other information on there, good resources. That's really the best way to kind of go through and getting in touch.
Great. And that concludes our show. Thanks so much to my guest, Erik Brenner, a founding partner and CEO of Hilltop Wealth and Tax Solutions. I hope you learned something about why you might need a personal CFO. I know I did. Thanks for listening. You've been listening to the Profit Minds podcast. This is your host, Dr. Stephen Kirch. Please visit www.profitminds.net for other episodes or to contact me. Thank you for your positive feedback, comments, questions, and for sharing this show with others. Thanks for listening. Have a grateful day.